All right, well, I guess we can get started. So first of all, a quick introduction. So my name is Rainier, and I'm one of the co-founders of Veylinx. And today I'm joined by Clark, who is my colleague and who is one of our senior research consultants.
Hi everyone.
Cool. And today we want to talk to you about inflation. Because of course, we are about 1 year in a time with a very strong inflation. And we see that there are some changes happening in consumer behavior. And that is what we wanted to talk to you about, to understand, well, what is happening in the market? How can we best equip ourselves and adjust our pricing in order to win? And from that, we have some advice for brands and how to best address this. You don't need to make print screens or anything. We will share the PDF version of the deck after it's with everyone. Also, it will be recorded and we can share the recordings afterwards with everybody who did not make it today. We use a particular study. So we have data from the US, but we try to keep it quite generic. So most of the findings that we have actually apply not only to the US, but also to European and Asian markets. A little bit before we get started on the methodology, because understanding people's response to inflation is quite a hard thing to do. If you use claimed research and you ask people, well, how do you act against inflation? You will probably get very different answers to how people actually act in times of inflation. And that is simply because there is quite a large bias between what people say they are going to do, what they think they are going to do, and what they actually do. And in order to make sure that we get as close as possible to that market reality, we want to understand how consumers act. And by understanding how consumers act, the only way to achieve that is with transactional insights. And transactional learning, that is what we specialize in at Veylinx, which is really learning from real transactions. And the platform, or our platform that we also used for this study, is used to understand, well, how much are people willing to pay for certain products? And we run this test a year ago, or 13 months ago, and also very recent. And we focused on one particular category. In this case, that is breakfast cereal, because we believe it is quite an average and a representative category for what is happening in the larger FMCG, CPG market, and even outside of that, even for subscription services or utilities, we see similar patterns happening. So the consumers that participated, they were first exposed to a product, and they were allowed to place a single bid with their own money with the opportunity to actually purchase it. So people were able to say how much they were willing to pay for it. And some people actually purchased the product, they paid for it, and we delivered it to their doorstep. So more or less you can compare it to e-commerce. And on top of that, we complemented it with a short survey to really understand the drivers and motivations for their behavior. To tell you a little bit more about the details of this study, I'm going to refer to Clark, who will take you through some details.
Awesome. Thank you, Rainier. So as Rainier mentioned, we ran a little case study to measure demand for a mix of existing products and new packaging innovations in the cereal category in the United States back in October 2021. And we ran the study across two market-leading brands, Cheerios and Frosted Flakes. And we reran the study this month to check how the market has changed over the past 13 months. And I should say that while we're using US data as the backdrop for some trends that we'll be discussing in this presentation, we know that these findings are similar to what we observe in other markets, particularly in mature economies. And the objective for our case study was threefold. So we first wanted to understand the potential of some new packaging innovations, so ideas like sustainable packaging or single serves. Secondly, to deep dive into the pricing dynamics of the category. So looking at things like price elasticity and pricing thresholds. And third, to measure the impact of overclaim, because as Rainier said, we know there's a big gap between what people claim and what people actually do. And as Rainier stated, we chose cereal as it sits conveniently between a necessity product, So think toilet paper and a luxury product. So think about your ready-to-drink coffee products. And we see trends rippling through cereals are actually pretty analogous to wider trends that we're seeing out there in the economy. And I should add the findings we see in cereals line up also with findings we see in products outside of consumer goods too. So products such as tech devices and services. So how has the market changed? So namely, how are consumers responding to these inflationary pressures we're seeing as we know they're impacting the wider economy? So food inflation is running pretty hot. So it's an average of 12.4% in the 12 months to October, according to the US Bureau of Labor Statistics. And in our cereals category too, we saw inflation was about 12% in our representative basket of products. And so another reason why we chose the breakfast cereal category. We know consumers are feeling the pressure because they're telling us they're struggling. So when we asked them to estimate average inflation in food prices, they actually predicted it was more than double at 25% compared to the 12.4% it actually was. And we really can't blame consumers. So about 70% of spending among US households goes on mostly fixed costs. So think about things like housing, transportation, pension plans and contributions, and healthcare. And we know that wage growth is on the rise. It's about 5.1% in the 12 months to October, according to the US Bureau of Labor Statistics, but it's simply not keeping pace with this inflation. And given core inflation is growing at roughly the same rate, so that's inflation minus energy and food prices, that means that housing is getting more expensive too. And so is transportation and so on. And that leaves the average American consumer with a lot less money to spend. So they have 21% less discretionary spending on variable costs. So things that are sort of in their control. And that accounts for products like food, entertainment, apparel, and services, and so on. So just a vastly less share of the pie that they're able to spend on discretionary goods. And so how are they reacting? So understandably, consumers are pretty price sensitive at the moment. We actually measured this in our case study through the price elasticity of demand. And that's essentially measuring how quantity demanded for a certain good responds to changes in price. And we can see here, taking our benchmark cell of the Frosted Flakes original, we see that price elasticity is elevated right across the relevant price range. And even at certain premium price points, we see that they've switched from being relatively inelastic, so unresponsive to changes in price, to being relatively elastic or quite responsive. And that's pretty evident from the results we see here. So what are consumers doing to cope with these impacts? We see a number of different actions that consumers are taking. So we see trading out, we see trading down, and we see general price sensitivity by shopping for discounts. So when we ask consumers how they're able to cope with the effects of inflation, we see that a good majority are eating out less and purchasing fewer indulgences, which means essentially trading out of their respective categories. And a good share are also on the hunt for cheaper alternatives, meaning trading down. And of course, consumers are also buying products on discount. And this is reflected in the price sensitivity we saw in our purchase or transaction data on the previous slide. And these trends are really playing out on a general level, not just a product or a category level. And this means that the purchase habits of consumers really are changing and have changed since we ran this study 13 months ago. And it also means we have to change how we approach value and pricing. So in the next section, Rainier will be taking you through how we can leverage and assess some of these wider trends.
Exactly. So as we see, consumers have the opportunity to change their behavior. They can trade out of your category, they can trade down within your category, or they become more sensitive to promotions and other alternatives to make your product more attractive. So we need to make sure that our proposition and our price is right. And for that, we want to introduce 3 different lenses to evaluate your pricing. The first one is a cost-focused lens, or in other words, an internal focused lens. It's actually the most simple way to evaluate your pricing. It is ultimately understanding what does it cost me to make my product, how much margin do I want to make, I add that on top, and that will be my selling price. Quite straightforward. The second one is an externally focused lens, where you are assessing the category where you play in, and you understand what your role is. So understand, well, what alternatives are there? Do I want to be more premium or more economic than my competitors? And based on the competitive landscape, you set your price. And the third lens, potentially the most challenging lens to understand, is the value focus lens. Really understanding how valuable is my product or how valuable is my proposition in the eyes of the consumer. And based on that, you set your pricing. And in order to get your pricing right, all three of these lenses must work together. If you get them all three right, you will be successful. But if one of these lenses is off, this will result in a massive decline of sales. And let me give an example of that. Let's say that you have your cost plus your margin in order, and that also you have the right place within your category. However, consumers do not see the value in your product. In that case, they will not purchase it. Or let's say that you have your cost and margin in order, and consumers do see value in your product, but you're not playing in the right place within your category. That means that there is a more attractive alternative from your competition available, and probably people would prefer to purchase that over your product. And if you play the right part in the category and consumers see your value, but you are not able to make your margin, well, I don't think I even need to explain that scenario, but that will not work either. So you need to make sure to have them all three correct. And let's dive a little bit deeper in that, starting with understanding your place and your role within the category. But before we do that, we must also understand what is the role of the category and how is the category perceived. And very simply put, not everything is necessary. Some things are essential, some things are more of a luxury. It's not all black and white. Some things are more luxurious than others. But because consumers have options, they can continue to purchase. They can trade down to a cheaper alternative, or they can stop buying a product from your category completely. It is crucial to really understand, well, how sensitive and how at risk is my category for really people trading out. Because if there's a big risk of people trading out, you have a very different strategy to follow, where you really need to understand, well, how can we keep making our category relevant than when people are just trading down and you know, well, I'm competing against just the other products within my category. So this is the first element that is crucial to realize. The second part that is important to understand is, well, within my category, what is the role that I'm playing? And every category looks a little bit different, but often there are 4 types of products that are coming back. And it all starts with the A label or the A brand, the category leader. They're typically relatively high in price, but they're also relatively high in volume. They're really leading the category and building the category. Just below that, slightly cheaper, slightly less volume, are the challenger brands who would love to take over that position from the leading brands. Then at the bottom, we have the retail or the value brands. They typically have a lower price and play on a higher volume. And at a smaller volume and a higher price, you have some niche products that only serve smaller subgroups within your category. What is also interesting to notice is that each of these different players have a different dominant lens. Value and retail brands typically mainly operate looking at the cost point of view to set their pricing. A-label and leading brands really look at, well, what is the value that we are bringing in order to set their pricing? And challenger brands are more looking at competition to understand, well, where should we position ourselves strategically in order to eat market share away from the leading brand. And with that, I would also like to give the word to Clark, who will tell us a little bit more from the study what we have seen in terms of consumer value evolving.
Awesome. Yeah, thank you, Rainier. So we understand a little bit more about how category impacts price and pricing strategies, but now we'll have a look at consumer value. So in an old school or traditional way, to answer the question around consumer value is simply to ask consumers, would you purchase this product at its respective price, at its respective recommended retail price, or what have you? And unsurprisingly, this consumer demand is quite overstated. And in fact, we saw in this particular case study, it was overstated by a massive 139%, which is actually a rise of 14% on last year when we ran the same exercise. But when consumers have skin in the game, like we saw in our study, in our behavioral approach, when they're risking their own money, we see results are a little bit different. And actually analyzing the transaction data from our case study, we can see the consumer value for the products in really sharp relief. Here we can see consumer values for our Frosted Flakes benchmark is holding steady. It's about the same, but actually demand is down because prices are up. So at its updated price of $3.79, demand for our Frosted Flakes benchmark is much reduced, while demand at its original price of $2.99 is basically flat. So demand is down because prices are up. And across the 7 products we studied in this particular case study, we generally saw the same pattern with a few interesting differences, which we can get into in a little bit. So how are these elevated prices impacting consumer demand? So a critical element to any pricing strategy is really getting to grips and understanding the impact of pricing thresholds. And you can see them pretty visually, pretty well illustrated here. And so understanding how price thresholds impact volume, revenue, and/or profit is crucial to designing a relevant pricing strategy. And taking our benchmark here, the Cheerios Oat Crunch Cinnamon, we see 3 main pricing thresholds, one at $3.50, one at $4, and one at $5, all of about equal magnitude. And as much of our cereals category approaches that $4 pricing threshold as their regular pricing, there's very little room for these brands to stretch in the cereals category specifically. We can see pretty precipitous drops in demand after these specific price points. Now, some strategic price points is really where you'll lose a massive amount of volume when you go beyond them. But this won't always be the case. And sometimes it can really quite surprise you. So I think a learning is to always be acquainted with these kinds of strategic price points before building out a pricing strategy in order to avoid that significant decline that we see pretty well illustrated here. And how can we play under these pricing thresholds? So most of us here have heard about packaging downsizing, which may also be known as shrinkflation. And in our case study, we were rather sneaky and we did test out a packaging downsize on the Frosted Flakes original to determine just how consumers might react. And so you can see here from a consumer value perspective, the results would suggest that it's actually could be quite a good and winning strategy. Consumers valued the products roughly equivalently with just a 2% difference at the regular pricing, despite a 16% reduction in pack weight, even when we visualized it on the shelf. Now, that's not to say this is always a good strategy. And of course, there are many risks inherent in this. And just to take an example from here in the Netherlands, we saw that Kellogg's recently reduced the pack size of its all-brand fruit and fiber by 25%, while lowering its price pretty marginally. And so while consumers didn't initially realize, and sort of like we see here in our case study, it was widely called out last week by several major media and consumer watchdog organizations here in the Netherlands. We also know that packaging downside can also come with sustainability impacts as well, which are rather important. That basically means more packaging per gram of product. In our example, that would be more cardboard, more plastic per ounce of cereal produced. And it's not something that we necessarily advocate for. But innovation that delivers relevance to consumers can really work. And as we know from the previous trends we discussed, consumers have less money to spend on disposable, discretionary spending, so our variable costs. So really our focus should be on holding on to value rather than driving trade-off. the latter being pretty unlikely in this sort of current context. They're nice to have innovations that we studied. So I think the single serves and the sustainable packaging there, they're in fact down in terms of overall value when we measure this in sort of dollars and cents compared to last year. So actually these innovations are becoming less and less relevant in the current context of inflation with less disposable income to spend. But rather, we really need to be building an argument for consumers to keep buying or to hold on to value with innovations that are really helpful and relevant to consumers, like a resealable lip, for instance, to improve shelf life, or getting creative with product changes so that we can ultimately reduce our production costs without impacting the consumer experience. So getting a little creative about how we reach relevance with consumers. And in our case study, we see that the value for the resealable pack here, which locks in shelf life, isn't any higher necessarily. It's essentially flat, but it is holding on to the value that it garnered in our case study last year, remains relevant for consumers. And so really, testing innovation to understand what works and what's relevant for consumers is really more important than ever before. And so with that, I'd like to hand the mic over to Rainier to wrap up a bit of the conclusions and our advice to brands moving forward.
Absolutely. Thank you, Clark. So in summary, I think there are three conclusions that we want to leave you with. So first of all, what we see is indeed consumers are becoming more price sensitive, and they are going to assess, simply because they have less money to spend, am I going to continue in this category purchasing as I used to? Am I going to stop, trade out completely? Am I going to down trade? And what they're for sure going to do is going to become more price sensitive. So what is important for you is to understand, well, what is the role of the category that I'm playing in? How sensitive are we to down trading, or how sensitive are we to trading out? And also understand what your role is within the category to make sure that you're pricing it in order to win. The second part that is crucial, and that is what Clark talked about, is indeed understanding those price points where consumers do not want to go beyond. If you increase your pricing beyond a certain point, people will drop out. It's crucial to understand those price points. Of course, you can grow as close to them as possible, but really you need to avoid going beyond those price points. And the final thing that you want to do is really to understand, well, what innovation can I bring that drives relevance to my consumer? And maybe the role from innovation is changing a little bit, because where you used to really be using innovation as a builder of value, can I charge more for my products if I bring this relevant feature or this relevant additive to my product? But now you can maybe even see it as more of a defensive mechanism where you invest in innovation in order to maintain the value that consumers see in your product. So these are really the three takeaways that we want to bring it to you. If you're interested to learn more, what Veylinx can help you with is indeed understanding, well, what are these strategic price points where I can grow towards? What is the added value that I can bring using my innovation? And indeed, we can simulate the effect of price changes within your category and what the effect will be on your share and on your pricing ultimately. I would now like to open the floor if there are any questions. If you have any questions, feel free to type them in the chat, or I'm not sure, Karina, if people can ask them, but type them in the chat if you have any questions. So I see one question indeed, to what extent the regional differences are there. So indeed, the data that we used for this study was all US focused, but we have seen quite similar trends, especially with how consumers are changing their behavior in response to inflation. It's quite consistent. So even though the data might be slightly similar, the recommendations would remain the same. So, hi, Charles, I see you want to know, well, how transferable are these lessons to other categories? The reason that we use the cereal category is that it's quite representative for what is happening in the market in general. We see that the number of inflation is almost similar to the inflation of food in general. It's quite in the middle in terms of the necessity of the category. So with that, we feel it's a very representative category in order to build our case around. So there might be marginal differences or unique elements for every other category, and we cannot, of course, test them all. But this is a pretty average category. So if the other categories are not too different, many of the lessons and many of the learnings can be reapplied there. Clark, do you want to take the next one?
Yeah, from Beatrice.
Yeah.
So how much time would it take to launch a study for 500 consumers, for example, in one LATAM country? So very executional focused one, and I love timelines. We typically take, as little as a couple of days to set up a study. We like to do things pretty quickly and efficiently, and that also extends to our consumer experience as well. So we want to make sure that consumers don't feel like they have to fill in 1,000 different questions with various different rankings and grids and everything. We really do focus on the auction element itself and understanding consumers' real transaction potential in terms of how much they would be willing to pay. So in terms of timelines, yeah, in a couple of days, we could really launch a study.
Right. You also want to take the next one, Clark? I think.
Yeah, from Jordan. Yeah. So do we have any
both of them.
perspectives on differences between channels, so supermarkets versus discounters, or in brand switching, manufacturer versus private label? So in this particular study, that wasn't the focus of the outcome. So we didn't really measure the differences between, for instance, supermarket loyal shoppers versus discounters. But in as far as I can say, anecdotally, working with different categories across different markets, we do see some very clear differences in terms of consumers' perceptions. So yeah, it's unsurprising. So in those more sort of premium channels, so think about your Whole Foods, for example, versus your discounters, your Dollar Marts in the US, we do see differences in terms of willingness to pay, and do see differences in terms of perceptions around private label benchmarks, for instance. For the brand switching question, we did actually capture some data around consumers' perception of private label specifically. So we did see actually quite strong responses from consumers around private label. So in fact, I think it was about 63% of consumers had some sort of positive perception of private label, and even more tended to act on it. So we saw about 85% of people that we'd sampled had purchased a private label or a store brand product in the past 3 months. And this is up on what we'd seen in the past.
Indeed. Great.
Quite a lot of questions coming through.
There are.
I love it. I love it. So maybe from Beatrice, one that detects in sources or whatever category the effect of price is. Yeah, I think that would be pretty similar, Beatrice, where we tend to be pretty category agnostic. So as Rainier was mentioning earlier, we do work with software providers, subscription services, technology products, and the like. So really it is quite a versatile methodology, capturing consumers' willingness to pay through the auction.
And I see a question from Jordan Smith on if we have noticed any differences in value perception based on shoppers. So perhaps maybe stronger or weaker purchasing power. I think we do see that. Maybe not per se that people value the products very differently. In fact, the overall valuation over the category was more or less flat, increased slightly even, but because simply products become more expensive, more people tend to drop out, or more people tend to not be willing or able to purchase them anymore. And of course, people with stronger purchasing power are less prone or less sensitive to that effect than the people with lower purchasing power. Further deep dives, I don't think we included in this particular study. Clark, do you have any addition on this?
Yeah, I think, no, very well said, Rainier. In general, we do see that, purchasing power and more affluent shoppers do, tend to have more money available, of course. And so we do see some interesting correlations between household income, for instance, and the ability to purchase a product, a particularly premium one. But it's not always the case. Certainly, we do see some products, particularly, more economical or potentially more cost-saving innovations that appeal much more strongly to consumers with lower incomes. So it's not always, I guess, what you might expect from an anecdotal perspective.
Yeah. And then indeed, the other question from Charles, indeed, while prices increase, we see consumers are buying less, finding ways to use less. Any hypothesis on how consumers might do that in places like cereals? Well, this is indeed one of the reasons why we selected the category of cereals for this study, because on one hand, well, there's quite some stickiness to the category. You will not just suddenly trade out of it unless you really have to, but there are alternatives. So indeed, maybe people shift to categories with less cost per meal, or they downtrade to value brands from the A brands that they would normally pick. So indeed, I think this is quite an interesting category where you actually saw both of the effects happening. Indeed, we will be sharing all the slides afterwards. We will also be sharing a recording. So everything will be shared with you afterwards. And if you're interested to discuss further, because of course this was quite generic, feel free to drop a note to myself or to Clark, and we will be happy to discuss further with you. Yes, I will make sure that we have an outline with the presenter notes in there as well. Absolutely.
Maybe quickly before we go, Rainier, I think we've got 2 additional questions from some attendees in the question and answer box. So one of them is, how's inflation affected brand loyalty? Have you found that consumers are more willing to abandon their favorite brands in favor of private label products? I think we sort of, we touched on that a little earlier. So indeed, we see very strong positive perception of private label or store branded products in our study. And in fact, when we profile Gen Z specifically, we don't see any negative sentiment across private label and store brand, plausibly because they have less disposable income to spend. And we do see that consumers are acting on these perceptions as well, and that a great majority have purchased a private label product in the past 3 months. And then a second question, what differences in shopping behavior have you noticed across different audience segments, e.g. younger versus older consumers? So I suppose really briefly, the private label is one. So we see Gen Z are very big fans of private label. None of them appear to have a negative impression. We do see slightly softer willingness to pay for Gen Z consumers, again, reflective of the fact that they tend to have lower disposable income. And then we also see, in terms of some differences there between age groups, that slightly older consumers were more likely to overstate inflation. Again, may be reflective of the fact that typically a larger share are on fixed incomes. And so therefore their disposable income's not rising in line with wage growth that you might see elsewhere in the economy. So their average guess was for older consumers 27% versus the 25% across the total sample. So a few interesting insights there when it comes to age.
Brilliant. All right. Well, thank you so much, everybody. I wish you all a great remainder of the day. And as said before, if you have any further questions, feel free to reach out to Clark or myself. Thank you.
Thank you.